As well as using financial indicators and ratios, there's a whole bunch of other analysis tools we can use to evaluate a business. And most of those are non-financial, such as customer satisfaction, quality assurance, the quality of the management, the profit compared to the hours worked, and the overall economic climate. So looking at customer satisfaction surveys, they might tell us how happy our customers are, which is a good sign that we're doing well. But happy customers don't necessarily translate to profitable customers. One thing we might want to consider is the level of sales return. And what we can do is almost calculate a little ratio and take all our sales returns and divide them by total sales. And that'll actually give us a little sales return ratio, which is not something we're expected to know. It's just a good little ratio because we can see if $5,000 of goods came back and total sales were 100,000, that'd be 5%. And that means that 5% of every customer that we sell to ends up returning their goods, which doesn't seem like a very good result. So that's another way to analyze our business. Are our customers happy? We can also look at quality assurance, and that's all to do with finding reliable suppliers, keeping them happy, and therefore making sure that we're happy. So one thing we can do is look at our purchase returns, and we can also do a little ratio for that. Again, we're not expected to calculate this or know it. It's just a little handy ratio we could do to analyze our quality performance. So what we could do is take our purchase returns, say that's 2,000, divide it by the total stock purchased, which was 50,000. That works out at a ratio of actually 4%, not 5 as it says there. And what that means is that 4% of all goods purchased are returned to suppliers. Well, that's good to know. That probably says our suppliers aren't very good quality. Maybe they're providing the wrong sort of stock, or maybe it's getting damaged, and it might be time to change who we buy from. We can also look at, in terms of quality assurance, changing who we buy from, changing the delivery methods, buying better quality stock if it's always getting damaged, just buying a better quality product, or maybe improving customer service so customers end up getting better service and not buying the wrong product which they subsequently return. We can also look at how good the management of a business is. Does the manager, which it could be the owner, have good communication and management skills? Can they adapt to change, develop new products? Do they have an experience and history in running other businesses? And have they got an education, particularly in finance and accounting, which is what we've been looking at? That's a really good skill to have as someone who's owning or running a business. Profit compared to hours worked is a really good thing to figure out because you could do anything with your life or with your money. Starting a business is one. Something else you could do is actually work for someone else. So there's less stress, probably fewer hours, but you don't have as much control. So one thing you might want to do is figure out profit per hour. So let's take the net profit, it could be for the hour, so for the week, for the day, for the month, for the year, and divide it by the amount of hours the owner had to put in. So let's say we made $1,000 of profit this week, but the owner had to work 40 hours. Well, we can figure out that that is $20 per hour in profit. That's probably a little bit less than someone could get in, a reasonably well-paid job with someone else. So that's actually something you might want to factor in, given that there's all the extra stress of running your own business. $20 an hour doesn't seem to be all that high. Economic climate would be the last thing we could analyze our business for. Maybe our profits fell and we were less profitable, but the economy was really bad. So that might be something we can look at and say, well, we actually did quite well. Maybe we've got a new competitor and we need to bear that in mind. Maybe wage levels and unions have increased the amount that wages have gone up, which has affected our profitability. Any sort of technology that can help to lower costs. All these things need to be considered when we're analysing a business.